Hey, thank you everyone for joining us today for what I've called the real estate review. Today we're going to be discussing what people can expect as we go deeper into 2026, interest rates and options for home buyers and um, for mortgages and how that will benefit sellers. And so to help me with this real estate review, I have Joshua Rubin here. He's the founder and president of Horizon Financial Group Incorporated. He's been a top 1% loan originator since entering the business in May of 1995. He's done over 1 billion in closed loans, has a degree in finance, and attended Michigan State and Eastern Michigan University. Josh is committed to making the loan process as simple and clear as possible and ensuring that his clients' unique needs are met at the lowest cost and rates.
Yeah. Hi,
So
Patrice.
thank you, Josh.
Hi there.
So the first question is, what are your expectations of the real estate market for the remainder of 2026?
So I think we're in a situation where when things are priced correctly, they sell quickly, and we are definitely seeing some things that are sit a little longer. On our end, from a financing standpoint, buyers are able to be a little bit more choosy right now. There's situations where a lot of people, if a house doesn't pass inspection in the past, they may have just bought the house anyway, knowing that there may not be any alternatives out there. That's not the case right now. So we do have situations where houses are failing inspections and clients are moving on to the next house. Just kind of a good point in making sure that that house is primed and ready to sell as far as that goes. With what we see moving forward, we're going to continue to see things become a little bit more of a buyer's market versus seller's market, a little bit more balanced, just because the fact that things are sitting a little longer, buyers are able to take a little more time before they make determinations, and they're able to look at a variety of different houses where they're not up against it and have to make a rash decision immediately, like in the past.
Yeah, that's pretty much what I've got, especially in certain areas that's taking a very long time to sell and get traffic or have a lot of traffic and there's no offers, or it is getting some kind of a bidding war, but not as strong as the bidding wars used to be. If you've enjoyed watching this video and would love to stay up to date when I have more content like this or something similar that you may be interested in, please like and subscribe to this channel and click the bell so you get notifications. And I hope you have a great day.
Yep.
Um, so the interest rates have kind of been trending down. Do you think they're
Mhm.
going to go up more, go down, or kind of stay the same the
No,
rest
I
of
think they're going to stay the same, or they're going to continue to improve slightly. So, like a 30-year fix right now is just under 6%, which is the lowest it's been in about 3 years. What is driving interest rates is economic data, and by that I mean that interest rates and inflation move in the same direction. As long as inflation continues to abate, then we will see rates continue to improve. The X factor is, war with Canada or uh, Greenland or anything else to that effect, where it's going to put, it's going to put pressure on the bond market, which is how interest rates are determined. So we expect things to hold tight with where we're at best by year's end. Perhaps there might be one more interest rate cut that's already priced into the market. So we don't expect rates to move significantly lower on a 30-year fixed at this point.
Um, and you did say you think it's going to be more of a balanced market. Every a lot of experts, quote unquote, that I've listened to and reviewed and everything, they're thinking balance as a whole for the whole year. Do you
Mhm.
think it'll go from balance to buyers truly, or you think we balance the whole year?
No, I think it'll if anything, it will tilt more to the buyer side, which we haven't been at in a long time. I do think it'll actually remain in balance only because you have those houses that are priced correctly, that are nice houses that are still selling quickly. It's the houses that maybe are overpriced as far as their list price goes, and maybe not the most desirable areas. Those are the ones that are sitting longer. I think it will tend to balance itself out. I don't think it's going to tilt one way too much or the other. I do think that it'll be a little bit more on the buyer side than seller side, at least for the near term.
Okay. And what do you think about the proposed opportunities for portable mortgages and 50-year mortgages?
So portable mortgages would be genius. I don't know how that will work in practicality because the fact that the collateral that is securitizing the loan is that particular property. So that'll be very interesting to see how that goes. That will be tremendous for homeowners. It probably will not benefit too many buyers from the standpoint of you're still locked into that low interest rate. So unless you really are in a situation where you have to move or you're looking to upsize or downsize, most people are going to keep their 3% mortgages unless they're in a position where they have to move or refinance or relocate. Um, from the practicality standpoint of things, it'll be very interesting to see how they propose to do that. Even if they do this, it's going to be a very long time in coming, just because you have the mortgage-backed security market. Like a mortgage is a financial vehicle, and it's sold in the secondary market. If these loans are originated in 2020, 2021, and they're super low, they've already been priced accordingly. So I don't know that it can work in reality. It's great to talk about. It would certainly be awesome, especially for homeowners. I don't see it happening. Certainly not in any time in the near future. Did you mention the 50-year mortgages as well, or just the portable?
Yeah, and I had a comment, I guess that'll be easier instead of commenting after you're done. Because what is that similar option that's been around before, where it's not a portable
Assume-
mortgage, but it's a assumable mortgage.
Yep.
I've I tried to do one of those in 2023 for a property because it was non-warrantable condo, and fortunately it was my listing, and the buyer actually wanted to do it, but it was just
A
too
nightmare.
much. Yeah, yeah, and it never, of course, didn't close.
Yeah.
But they said, they were starting to get more of those. But I mean,
So an
do you think
assumable mortgage, so the only loans that are assumable are VA loans and FHA loans. There are some ARMs from a long time ago that are still assumable. So in order, and you can have a non-veteran actually assume a VA mortgage. It is absolutely a colossal struggle. I mean, it takes a long time to get situated. And then please keep in mind that that buyer still has to offset what the profit will be for that seller. So they're assuming the mortgage and what's owed, but if they owe $150,000 on the current mortgage and they're selling it for 300,000, that buyer still needs to make up the difference to that seller. Now, assumable mortgages are very tough. For a minute there, they were marketed very heavily, especially in areas that have a strong military presence, because there's a lot of VA loans. They are doable, but it is an uphill battle for sure. And many times people will just end up getting frustrated and move on because of how difficult they make it.
Yeah, so my thought was portable mortgages, would they have to work the same where the buyer would have to get another mortgage or pay extra because most likely the home they're buying is, well, it could be less, right? But more than likely the numbers aren't going to equally align with what their current mortgage is on a home.
So the way that I would envision it is that, let's say there's a mortgage that remains for 20 years and you owe 200,000 on it, and you go to buy a house that's higher than that. The $200,000 that you owe currently will be portable to the new property. But that buyer is going to need to make up the difference between what they owe on the current mortgage that was transferred to the purchase price. So again, in theory, it's great and it's awesome to talk about, but in practicality and reality, I don't think it's anything that can easily be consumed, and certainly not in the near term. Yeah, it's designed to get headlines. It's great, again, for those that are trying to get the phones to ring and otherwise, but it's something that's just not practical.
Okay, and so yeah, what about the 50-year mortgages?
So yeah, so keep in mind the reason why banks lend money is because they're going to make that interest over the life of the loan. On a 30-year mortgage, if you borrow $100,000, if you kept in that loan for 30 years, you're going to end up paying more than double in interest. So if you turn around and amortize a loan over 50 years, the monthly payment is certainly going to be less, but the cost to the consumer over the life of that loan will actually be significantly higher. The whole purpose of a 50-year mortgage is to increase affordability. And so in that case, there are other programs that will help for affordability more than a 50-year mortgage. The reason for that is because the rate on a 50-year mortgage is going to be higher, because the fact that it's going to be higher risk for whoever's going to make that loan and whoever's going to purchase that mortgage in the secondary market. So in reality, if you do the payment between a current 30-year fixed and what a proposed 50-year might look like, there's not a tremendous savings to be had to increase affordability. There are other options from an affordability standpoint. Like we have amazing 7-year ARMs that have rates that are in the low fives. That's a great way to increase affordability, especially for first-time home buyers, as opposed to a 50-year mortgage, which in the long run is going to actually end up costing them significantly more money. Even if they're only in that loan for 5 to 7 years, it's still going to cost them significantly more money than it would if they did a 30-year fixed or a 7-year arm or something to that effect.
Okay. Yeah, I wasn't thinking that that was a good option at all. Um, you just talked about a few, but are there any new options for buyers from getting a mortgage to make it easier for them to buy a home?
Well, so you're starting to see arms come back to the market so that they weren't prevalent in our channel for a very long time. There's still not readily available for Fannie and Freddie. We have some partnerships with some credit union consortiums that we're able to do 7-year arms and 5-year arms that are in the very, very low fives. That's not available to readily in the market, so it's an advantage that we have. Um, if you think about it for a second, we have tons of clients that might have bought a house in the last 3 years and their rate might be at, 6.99 on a 30-year fixed. If we refinance them to a 7-year arm where that rate is at 5.25%, those savings are magnified, especially if a client only plans on staying in a house for 5 to 7 years. Those are not toxic arms like in the mid 2000s. These are conventional arms. The rate is fixed for 7 years. Even when it does adjust, it can only go up or down by a maximum of 2% each change date. It's a really good way to tap into additional affordability. Yep.
That's good to know because I think most people are still thinking that they're going to be how they were all that time ago and that the buyer should not do it.
Yeah.
Um, so how would you say that would help home sellers when selling their homes amongst, competition? Like there's a lot more homes available for sale in their neighborhood or close by.
It's going to take the right realtor for sure. That's where you come into play. I think that you're going to get back to situations where you might see more open houses. You might see a realtor showcase that house a little bit more than they had to in the past in order to have it stand out. I think you're going to see a lot of homeowners that put a little bit more money into their house when they're going to sell it for the purpose of making it more attractive. It's not so cutthroat right now. So if your house is not priced correctly and in first and foremost from a price perspective, but if it doesn't have that curb appeal, if it's not something that's going to move the needle for most buyers, that house is going to end up sitting. And so I think what's going to happen is you're going to see a lot more professional realtors who are, instead of onesie twosies, but people that actually do this for a living, are going to help these sellers prep that house properly so that it will show the best way possible and sell quickly. And again, I want to suggest that anything that's priced correctly, even if it may not be in the best condition, will still sell relatively quickly. It's the ones that are laboring on the market because they're vastly overpriced. Those are the ones that are going to continue to sit unless you have a more realistic seller.
Yeah, because I also feel like sellers are, or realtors as well, they're saying, okay, the home is worth this, right? But they're not having the conversation of saying, well, it's a different market. So yes, it could sell for this, but are we going to get a buyer for this? So maybe we need to price it so we do get a buyer. And
Mhm.
I think towards the end of last year, I was getting a lot of listings off the market, put it on, take it off because they weren't good with taking less, even though they could.
Another
They don't
good
have to
alternative.
sell.
I was going to say another good alternative to that, for a seller to make the house more attractive, is to offer a 2-1 buy down to a buyer, where it's a seller's concession, where let's say the current rate is 5.99%. What'll happen is for the first year, the buyer will make a payment based on 3.99%. The second year, they'll make a payment based on 4.99%. And then for the remaining time of that loan, it'll be amortized in payment based on the 5.99 rate. So what that does is that it helps the seller get the price that they're looking for. Okay, because they're not going to cut the price and offer to do a 2-1 buy down because that's considered a seller's concession. So it helps them keep the price where they want it to be. It helps them make their house be more attractive to more buyers. It helps the buyers because it increases affordability. That's not an adjustable rate. It's just that 2-1 buy down, the payment is subsidized by that seller's concession. So if the payment is $1,000, let's say at 5.99%, I'm just making up numbers here, and the payment for the first year, let's say, is $700, the concession that is given by the seller is held onto by the bank. They turn around and supplement that payment for the first 12 months. So the buyer pays $700. that $300 difference comes out of the concession. It's a great way to increase affordability to make a house way more attractive. It's a 2-1 buy down. There's actually 3-1 buy downs as well, where it goes 3-2-1. The seller's concession on that is considerably higher, so it definitely needs to be a higher priced house in order for that to work. There's actually one down buy downs as well. So meaning where the seller can pay a concession where the payment for that first 12 months is based off a rate that's 1% less than the current market rate.
Yeah, no, I think that even more now, right? Knowing mortgage options could
Mhm.
be a big benefit to getting houses sold. And if the buyer, the agent doesn't know, at least us as listing agents could be informing people more. Like there's a house last year I sold that initially um they wanted to give us like $20,000 less, but because we knew that the interest rates went down recently, now we're gonna get that 20,000. And then, everybody was happy and we still closed. And it's just, scary too, because people are concerned about the economy and things like that. So I think even more just knowing what your options are and how you can save some money can make it or break a deal.
Yeah,
Uh,
there's definitely a K-shaped economy going on. Those that are doing well are still spending freely. Those that are, maybe people that live more hand to mouth as far as that goes, more blue collar, more middle class, they're struggling. Think about how expensive things are now relative to where they were 4 years ago. The best way to create wealth in this country is home ownership. But if the barrier to home ownership is so large, you're going to continue to see where more people are going to end up renting versus buying just because they can't get into the actual house. We're seeing a lot more professional loans. Like we have an Unreal doctor loan. So like if we have a doctor and it could be on any purchase, and it's really not just a doctor. There's like 36 different medical fields that somebody could be in, including an RN, PT, a nurse anesthetist. Like there's so many different categories. If they have a 720 credit score, I can get them a 30-year fixed under 6% with no money down and no PMI. So like there are products that are coming to the market that are definitely helping buyers. It just again it requires that buyer to make sure that they're working with the correct lender that's going to offer them that programs, the breadth of programs that are going to help them achieve success.
yeah, because the right lender could make or break how much everything costs you, or if it closes at all.
True.
Um, so what types of buyers are you seeing mostly getting pre-approved right now?
Um, so what we're seeing right now, actually, we're seeing a lot of clients that we have gotten pre-approved over let's say the last 18 months that it just hasn't worked out for them. They're coming back to the market. I have a lot of deals in our pipeline right now that these are clients that I've been working with for almost 2 years. They may have put in a ton of offers in the past only to get beat out. Well, now they're finding that they're able to get into a house, actually in some instances at a lower price or higher price point right now, but in reality, more affordable because interest rates are down. So we have quite a few of that going on. So clients that looked, a year ago, 2 years ago, they had no success with getting offers accepted are now getting offers accepted. We have a pipeline full of clients just like that, which is really nice to see.
Okay. And then the people that are trying to get pre-approved now that are newer, I guess not your older clients, are you seeing that a lot are having higher debt to income ratios more than normal?
Yeah, and that's a good point you bring up, and it's just because things are so much more expensive, and that debt to income ratio is crucial. Like, what somebody can afford and what they can qualify for many times is completely different. We got to make sure we're setting up that buyer to succeed, and we got to make sure they can sleep at night. So just because they can afford a potential house doesn't necessarily mean that's the house that they should be buying or that price point. So we are seeing higher debt to income ratios. Some programs, like government loans like FHA or VA, you can go to a higher debt to income ratio. You're going to start to see conventional buyers that when they have a situation where maybe they haven't been able to sell their house or they're getting into a new house and all of their equity is tied up in the current house, we're starting to see some more buyers that are going to like an FHA loan versus a conventional loan because the fact that you can go up to roughly a 55% debt to income ratio, which increases their buying power and what they can qualify for. Then once they turn around and sell the current house, as opposed to doing a recast, they would do a refinance, use that capital that came out of the sale of their house, go back to a conventional loan, and then turn around and set them up for the future. It requires a little creativity right now, because it's very difficult to get an offer accepted contingent, especially depending on the area. So if somebody is trying to get into a house, they don't have a large down payment, there's absolutely programs. Like, even you don't have to be a first-time home buyer to be able to go 3% down. If there are certain caveats, but we can still make it a low down payment, even if they're not a first-time home buyer, so that they can get into the new house. And then once they sell the current home, we do what's called a recast. So not a refinance. It's where they take the money that they got out of the sale of their house and they apply it to the principal on the new loan. That lender will recalculate the mortgage payment based on the new unpaid principal balance. It's very nominal. It's like $150 to $250 fee. But if somebody is in a cash position to purchase and they qualify for their current house and the new house, it's a great way to get into a home without making a contingent, but still setting up the client to succeed.
Oh, no, that's really good to know. And so that's what's I gonna say? Yeah, that's better than trying to do a bridge loan. Um,
Yes. We have bridge loans as well, but they're not for everybody. Again, they're costly in many instances. They're also not necessary. You're going to pay a second set of closing costs, for an appraisal and otherwise, when there might be other options that are more suitable than a bridge loan. They do exist. We do have them. They're just not for everybody.
yeah. Okay. And because they have to have a certain credit score and these people may not have that.
Yes, credit score, certain equity position. It helps if they're using the same lender for the financing as the bridge loan. You'll get much better terms that way. But again, we think many times there's a better alternative than doing a bridge loan for clients that are trying to purchase before they sell the current house. In the old days, when I say old days, I'm talking like a year ago, you could have somebody make an offer not contingent on the sale of their house, but be able to sell their departure home within that financing period, because the market was so hot at that point. So meaning that the offer is not contingent. The game plan is to sell their current house while they're purchasing the new house, close on the sale of that house so they have those proceeds to get into the new house. That's much harder to do right now just because things are sitting a little bit longer than they had been.
Yeah, because you used to get people say, "Oh, my house is going to sell really fast. I'm not going to put it on the market so I find the house." But then you do have to sell the house.
Yeah.
It's a lot.
Yeah, we're seeing a little bit getting
To not
back to
have.
more old fashioned, getting back to normal, which I root for normal. Okay. It's not necessarily healthy to have, bidding wars and $50,000 appraisal gap guarantees. That's not great for the market. I long for the days of normalcy when you can really be an advocate for a buyer. You can help them find that right house, set them up to succeed. I say that a lot, but it's a mantra here. It's something that we live by. We want to set people up so that they can succeed, create home ownership.
Yeah, a lot less stressful for the buyer, especially if it's their first house,
Hmm.
and not regret it later, right?
True.
Um, so, obviously everyone would love to buy a home and spend less on that home,
Mhm.
to save money. But I think you did may mention a little bit, but are you seeing more than normal that what they can or want to get pre-approved for is less than what kind of home they're looking for is worth, and they aren't willing to sacrifice on that price?
I do. So again, we're seeing clients that are making more educated decisions. Like, we're not seeing clients make such rash decisions where they have to in order to be able to get an offer accepted or make an offer, with no money for occupancy or waiving inspections or appraisal gap guarantees. We're starting to see less of that. Just getting back to a normal transactions where that's not necessary. Um, we do have, again, there's really two types of clients. There are clients out there that, because of the uncertainty in the economy, even if they were in the market, they no longer are because they're just afraid of what the future might hold. We have clients that may have been looking at a higher price point, but because of that economic uncertainty, they're looking at lower price points. There really is legitimately a K-shaped economy where those that do well are still doing very well and buying high-end properties easily with large down payments, if not even paying cash. And then you have those, especially a majority of first-time home buyers, who are not in that position where every dollar matters and where you try to find the best way possible to get that payment in line with what their budget is. You don't want to be a situation where they can go rent a property for significantly less money than what they can purchase, because then you're going to turn around and see where rents are going to go up because more buyers are buying or renting apartments versus buying a home. There is that is something to be a concern about. That affordability point of view is tremendous. Like anything we can try to do to make it more affordable for somebody to get into home ownership is something that absolutely needs to happen in our industry.
Yeah, I've on the listing side, I've seen more that I think I mentioned before where I would get a lot of traffic,
Mhm.
but not an offer. And they like the home, whatever, but what they wanted to offer would be a whole lot less. And until we came down to a more realistic number for them, they wouldn't even offer that number. Um, and I think that is more of the first time home buyer, but I've had other listings where they sell pretty fast until you're saying they're paying cash. But even people who have the money, I've seen too, where like they just don't want to do it. It's not
Yeah.
that I can't do it. I just don't want to do it.
An alternative to
Um,
that is in some instances, keep in mind for every $10,000 somebody puts down on a mortgage, the payment's only going to change by about $65 a month. So we're seeing a lot of clients that are putting down less money because the fact that more bang for buck, meaning that $65, it might be a tank of gas. It may not do anything that's going to affect their lifestyle. So they would rather hold on to more of their savings in case things do turn economically as opposed to putting it into the house where they're only going to save $65 for every 10 grand. Like, think about it, $20,000, you're looking at $130 difference in payment. That $20,000 might be better served working for them or in the bank for peace of mind than it might be a monthly payment that's $130 less.
yeah, I think I'll have to say that more often now. Then yeah, I do have some buyers too that I haven't shown them anything yet because they don't want to be in a certain area. They're not willing to sacrifice and just wait for the right one, which whenever that will be. Um, so I mean, we kind of talked on this for the most part, but if there's anything else you want to add, buyers taking longer time to make a decision to write an offer or not willing to make a competitive offer.
So what I would love to actually kind of throw out there is the fact property taxes in the state of Michigan. Because of Proposition A, we're seeing this happen a lot. So like you might have a house that is just turning over for the first time in 25 years. Well, the way that Michigan law works for property tax is that the homeowner, those taxes can only go up the lesser of 5% or the rate of inflation. When the property changes hands, that cap comes off, and we've seen instances where taxes are going up 4, 5, 6x from where they're at right now. So if you have a first-time home buyer where every dollar matters and they're setting up a budget based on the current taxes, if that lender and that realtor don't prepare that client for what it's going to look like 12 months from now, you're setting up that client not to succeed at that point. You're going to create significant payment shock. And so when we work up these fee worksheets for clients and we see that those taxes are artificially low, we're providing them that state of Michigan property tax estimator so they know what those taxes are going to be 12 months down the road. Because we're just seeing tremendous pop in taxes. Even in the city of Detroit, again, some of those properties haven't changed for so long. When the cap comes off and when you have 90 mills, for the millage rate, those taxes can be astronomical and people are not altogether prepared for that.
Yeah, I feel like that's why some of these people they've been putting their home on the market. Have only been in the market after only being in the home for like 2 or 3 years.
Yeah.
They didn't know the taxes were going to be this high after they bid way over the value of the house. And then yeah, just when I just closed, it took him some time. I think he took a full 2 weeks.
Mhm.
But yeah, people have been in the house for 30 to 40 years. But I let him know he could get the NEZ taxes for Detroit,
Yep.
which will help some. But at least once he made a decision, he knew what he was getting and the price was going to be.
So, and
Those
that's not even the city of Detroit. That's all over Metro Detroit. Then that cap comes off. It's more pronounced sometimes in the city because houses are turning over and those taxes are getting reset and the millage amount's so high. But it's happening everywhere, not just in the city of Detroit. Uh, you know,
Oh yeah, no, sorry. What I was saying was at least in Detroit you have the NEZ tax
yes.
benefit and that home did qualify for it and they were there for 40 years, so I think that helped. But yeah, the other houses where they've been only been there for a couple of years, it's been more in the suburbs that I've seen so far. Not to say it can't be Detroit either.
Yep.
Um, but at least they sell the house, right? They get
That's
out of
true.
it. Um, do you think we will see more foreclosures this year?
I don't. And the reason why is because with the advent of Dodd-Frank, which went into effect in 2011, it created a ton of consumer safeguards. A lender does not want to foreclose on a property. And when we had all those foreclosures way back when, you had clients that were getting into houses, with 550 credit score, 100% financing, no money. They had no skin in the game. So when things went awry, it was literally easier just to give the keys back than it was to try to save the house. Right now you have equity so high in these houses that a borrower is going to do whatever they can to stay in that house because it's worth so much more than what they might owe. The lender itself is going to do anything they possibly can to keep that client from foreclosure. They might do forbearance, they might do counseling. There might be a million different things that lender is going to try to do. Foreclosure will absolutely be the last resort. I don't think you're going to see a ton of foreclosures moving forward.
Well, that's good and good for buyers to know because they're hoping for them. Um, but they don't think about everything else that's involved with the foreclosure either.
Correct. Yes.
Um, so what are your thoughts on the ban of institutional buyers from
I think
buying?
it's good. Well, because what we saw for a minute there, especially in a COVID world, you'd have huge institutional investors. They created a market, right? So they would turn around if a house was listed for 400,000, they would go in and buy that house for maybe 450, 500, sight unseen. What they do is they're creating a market. Then they would turn around and buy up as many houses as they could in that general area because now you have a comp at 500 grand. So I mean, unfortunately, it was actually genius, but they created a market where they overpaid initially to bring the market up to consume a bunch of different houses there at those price points, which in turn was very profitable for them. I love the idea of banning institutional investors only because at that point it allows more first-time home buyers to get into the housing market. It's going to open up more opportunities. You're going to see houses that a lot of times institutional investors, they buy up these houses before they even hit the market. It's especially if they're buying pockets of houses. I am definitely a fan of eliminating the institutional investors, at least in certain areas, so that it does open up more housing stock for more people to purchase.
Yeah, I think that's the key point there is them buying all these properties off market that is contributing to the low inventory.
Mhm.
I was thinking, if it could at least be a scenario where they're limited on the amount or limited in when they can buy the property. That way, if there's a seller who really needs to sell a house, then they have the opportunity, but they're not taking away the advantage of the buyer first.
Correct.
Um, but that was my last question. Did you have anything else you wanted to add?
No, just I love working with you. I love when you put these together. These are great. I'm always happy to help however I can, and just wishing you continued success.
Thank you. Well, I think this was very good information. And yeah, so if anyone is looking to get a mortgage or refinance or anything like that, how can they reach out to you?
Honestly, cell phone's the best bet. Quick text message, a phone call, 248-797-5206.
All right. Well, thank you, everyone, and hope you have a great day.
Thanks, Patrice. Take care.
You too. Bye.
Bye.